tightening global liquidity, and when global liquidity tightens, it's obviously not good for economic growth, and it's not good for asset markets. And so this is very important to, in the analysis of future trends, as soon as the dollar is weak, it means money is flowing into the world, there's excess liquidity again, and then asset markets go up, including, of course, equities and also gold and silver and other commodities. Now, what happened in 2008 is unusual in a historical sense because, A, equities totally collapsed. They lost from peak to trough $32 trillion. Now, recently they've rebounded somewhat, but we're still much below the peak here. And also what is different from a historical point of view is the following. We had very serious recessions in 73, 74. In my opinion, more serious than what we have had so far this time around. We had a very serious recession in 81, 82, and also a minor recession in 1991. But in these past recessions, you can see that home prices in the US, here is 73, 74, here is 82, 90, they never went down. In 1990, they briefly went down because of one state, California. But basically, we never had house price declines. And therefore, people in America said home prices will never go down. But this time around, you can see that home prices really collapsed. This is unusual, and it destroyed a lot of wealth. But the Federal Reserve, again, will tell you, well, the problem is that home prices went down. But that is not the problem. I want to explain to you what the problem was. Here you have at the bottom of this figure homeowners' equity. Homeowners' equity means how much money people have in the house. Say if you buy a house for 100,000 and you pay 80,000, then you have 80% homeowners' equity. You only borrow 20,000. And that was the pattern in the 1950s, and even here in 1973, 74 and 82, we had a home owner's equity of 70%. But encouraged by the Federal Reserve, and by the way, also by institutions that are government-sponsored, like Fannie Mae and Freddie Mac, people borrowed more and more against their homes, and so home owner's equity here declined very strongly and is now, at the present time, just 43%. In other words, of all the homes in the United States, 43% is own capital and 53% is borrowings. Now, 33% of homes in the United States are owned without any mortgages. They may have been bought 50 years ago, and so they have no mortgages. They're fully paid. It means that 67% of homes, they have now 15% or less equity. That is the problem. If you own your home and you have no mortgage and no debt, it doesn't matter the house goes up 20% or down 20% or 30%, it's still the same house. The problem is the leverage. That is the problem. In Hong Kong, after 1997, home prices declined by 70%. None of the major developers or construction companies went bankrupt. And very few homeowners went bankrupt. Why? Because they had low borrowings against their homes. And the property developers in Hong Kong, their capital structure is usually about 80% own capital and only 20% are borrowings. And so that is the big difference between other countries and the US. In the US, we have simply too much debt. Debt to GDP is too high. That is the problem. Now, I mentioned that the Federal Reserve, in the period 2001 to 2007, never pursued tight monetary policies. And let me explain what I mean by that. If you're a central bank and you want to tighten monetary conditions, you can increase interest rates, but you have to increase them up to a point where credit growth slows down. And at that time, when credit growth slows down, you have tight monetary policies. Now, in the case of the US, you can see that after I showed you 2004, they started to increase the interest rates in baby steps from 1% to 5.25%. But what happened is, here, credit growth in 2004 was 7% annual rate. And then it accelerated to a peak of 18% annual rate of credit growth in the United States at the end of 2006. And that is most unusual. I mean, that the Federal Reserve could sit there and sleep over this and not realize that this was not going to be sustainable in the long run, to have credit growth running at 18% per annum, and also to see that credit was growing at 5 times the rate of GDP growth. Between 2000 and 2007, total credit increased by $21.3 trillion, but the economy only expanded by $4.2 trillion. So in other words, credit was growing at a much faster rate than economic growth. But the Federal Reserve didn't see that. And then when the crisis began to unfold, and the Federal Reserve initially thought that the subprime lending crisis was an isolated event, but eventually they noticed that the whole United States was subprime. And so credit growth began to slow down here in 2007 at the beginning, but when they cut the interest rates, it expanded once again. In other words, as I said before, the Federal Reserve has destabilized the economy more than would have been the case if the Federal Reserve had done nothing. And then, when the crisis really spread in 2008, credit growth collapsed. Now, if you have an economy that is dependent on continuously increasing the amount of debt to create economic growth, then obviously once you have this credit slowdown, you have a major problem. Now, the Federal Reserve knows about this, and therefore what they've done is basically, you have here the private credit is contracting. In other words, people, normal people, they're acting rationally. They see a problem, so they start to save and spend less and pay back debts. But here comes the government, and the government increases its balance sheet through large fiscal deficits. This year, the total credit of the government in the US, in other words, the total debt, government debt, will increase by more than $2 trillion. And the Federal Reserve is expanding its balance sheet. In other words, they're printing money. They're buying treasury bonds and agency securities and expanding its balance sheet. So you have two opposing forces. And the private credit sector is withdrawing money from the system and saving. The government is throwing money at the system. And that then creates huge volatilities in asset markets, because at times the private sector is overwhelming the government sector, and so it's negative for asset markets, like in 2008, and then comes the government, prints money like crazy, and that's why you have this huge increase in commodity prices and in stock markets after essentially the beginning of this year. First, the commodity markets bottomed out, and then the dollar peaked out February 28, 2009, started to go down. March 6, the S&P was at 666, it starts to go up, and as you know, we went now to close to 1100. So this policy of the government to print money and create huge fiscal deficits, that is creating additional economic and financial volatility. But I want to explain another point. The government in the US is adding, say, at the present time, $2 trillion to its government debt. And so the government debt is expanding very rapidly as a percent of the economy, and it will reach, in my opinion, in about 4 years' time, 100% of the economy, 100% of GDP. The problem will be one day when the Federal Reserve should increase interest rates, because there could be some inflationary pressures in the future. And so when the Federal Reserve should increase interest rates, they'll be very reluctant to do so, because at that point, if they increase interest